Well, I think you've hit the nail on the head already just by talking about, that stress testing being the real mathematical truth teller. There's no place to hide when you strip everything down and you just look at the performance. What you're describing, Darren, is such a great practice, and it's a reason that Nationwide loves to partner with Lionsmark. We know that you are doing things the right way. You are being overly transparent in a really good way and showing the client what could happen and just making sure that you're working with well-qualified buyers.
I'm Darren Sugiyama, CEO and founder of Lionsmark Capital, the most transparent premium financing intermediary firm in the life insurance industry. So in today's webinar, we have a very special guest, Alisha Zaayer, who is the Divisional Vice President of Nationwide. Nationwide's a great carrier. They've got a great IUL product, and we have a really budding relationship with Nationwide and the entire team over there. In today's webinar, Alicia is going to share with you a little bit about her background, how she got started in the life insurance industry, where she's at now, and most importantly, her perspective on the state of premium financing, where we are in the market today. So I think you're in for a real treat. Okay, so Alisha Zaayer, welcome.
Thank you.
So I know your official title is Divisional VP. Could you let us know a little bit, what exactly does that mean? I know essentially it's a different way of saying you're the head honcho of sales for Nationwide on a national scale. What exactly does your job title entail?
Yeah, so the Division VP role at Nationwide is a national position, and we're broken out into various distribution groups. There are three main distribution groups. Producer Group is one of our largest distribution channels, and so my role is to cover all Producer Group relationships with a team of wholesalers, placement coordinators, case designers, lots and lots of sales support folks at Nationwide for Producer Group.
So how did you get to this position? If you rewind the clock back to, I don't think anyone in the insurance business planned to get in the insurance business. So how did you get into the life insurance business? How did your career evolve into this great position you're in now?
Absolutely true. You're right. It actually started back in college. So I went to UC Irvine undergrad and I was tired of waiting tables. So I decided to get a nice office job at the local Northwestern Mutual Life office. So I started there, went on to law school after that, and thought I was leaving the insurance world behind, but that was not to be the case. Ended up passing the bar in 1996 and then started with one of our peer competitors in Southern California. I'll let you figure out who that is. But so for a number of years there, did some wholesaling, managed their premium finance program for about 7 years, and then went into channel management. And then the opportunity at Nationwide came up to really build out the Producer Group distribution. So starting in 2020, came on to Nationwide, and we've tripled our business in just about 5 years and still growing, on track for a record year this year.
Awesome. Awesome. Congratulations. So,
Thanks.
yeah, I've been trying to do business with Nationwide for years, and the product just didn't seem like the right fit for the way that I was modeling some of the premium financing loan models. But I started taking a much closer look at it over the last year. And you saw the webinar I put out about Nationwide versus Carrier X when we do all the back testing and stress testing. And the current Nationwide IUL product, I think, is fantastic. And I know the current version's been out for a while, but as we discussed earlier, it's gone through a few versions and upgrades, but the state that it's in now, I absolutely love. Um, Maybe if you could shed a little light on what you think is unique and so efficient about your current IUL product.
Yeah, and thank you so much. We really do always work hard to provide the very best value that we can for the consumer, and also to have a product that works well from our financial advisor's standpoint. It's always intended to be a low-cost product, building in as many guarantees as we can so there are fewer moving parts. And I suspect that's why you're seeing it show up really well when you're stress testing is if you're having a fantastic market cycle, it's going to perform extremely well. And if you're having a bad market cycle and the returns are not as strong as you would like them to be, it's still going to perform really well next to our competitors, especially. So that's probably at the heart of what you're seeing in the product and why it's working so well from an illustration stress test standpoint.
Yeah, it was really impressive. And I've been preaching this for years that the stress testing model platform software, whatever you want to call it, that we developed, really it's really more of a mathematical truth teller. You really get to the real mathematical truth of whether that product is efficiently designed or not when volatility comes into play. And in that webinar, you can, for anyone watching this, you look this up on my YouTube channel, where I compare the back-tested version of Nationwide's product versus another carrier's product. And what I found so interesting was the other carrier's product illustrated so much better in the carrier illustration, where you get that positive index credit every year. But when we looked at the best 40-year period and the worst 40-year period out of 121 different periods that we analyzed, the Nationwide product build, the chassis with the charges methodology and the floor and the cap, et cetera, it was so much more efficient and showed much better than we called them Carrier X, the other carrier's product that illustrated better, but actually performed not as well as Nationwide's in the back test. Um, what do you think the factors are that really make a carrier's product stand up over time?
Well, I think you've hit the nail on the head already just by talking about, that stress testing being the real mathematical truth teller. There's no place to hide when you strip everything down and you just look at the performance. Oddly and ironically, AG49 is intended to ensure that consumers are seeing the real deal in products and not seeing non-guaranteed bonuses and performance factors and whatnot, which can be really great tools in a product, but if you can't illustrate them, it's difficult to see what the real product looks like. So, what we've done is making sure that we lock down as many elements as we possibly can, making them guaranteed. And then, of course, our track record over the course of our history is really good and favorable for our in-force policyholders. We have never raised the cost of insurance on an in-force block of business. We've honored all of our non-guaranteed elements. And so, again, I think that continues to play really well in the real performance and not just the illustrated performance. Because to your point, that illustrated performance is one thing, but when push comes to shove, you want a product that is going to be there and going to perform well in reality.
Yeah. Yeah, I love what you said about the historical performance, and even more importantly to me at least, the historical um experience that the in-force block of business has had with a particular carrier. There's one particular carrier, won't name the carrier, but if you bought their IUL 6 years ago, the cap was floating around 10% or so. That same carrier's cap today is floating around 10%. The problem is that the product that was bought 6 years ago, that block of business is renewing with a cap of four and a quarter.
Oh boy.
That's the cap, the maximum allowable return, not the average, the maximum. That product is not sustainable over time. And it's so crazy when producers will ask me, "What do you think about this product from this carrier, et cetera, et cetera?" And it's like, to me, you've got to look beyond the current illustration, because all that is a hypothetical depiction, where everything's rosy. We definitely look at the back-tested outcomes when we look at product versus product versus product. But then there's the historical way that the carrier has treated their in-force block, and renewing at four and a quarter they're basically saying, pardon the French, but screw you guys, we don't care about you. And all we're going to do is
Policy.
use the detriment of the loyal customers, and use their detriment to the advantage of marketing a new shiny object to new customers, and they're going to end up screwing the new customers too. So,
That's exactly right.
what have you seen in terms of how Nationwide has honored their commitments and the way that management treats the in-force block of business?
I'll tell you by way of example. The largest set of cases that we have ever received and issued in the life division came in this year, a block of 7 policies from another carrier that I will not name, because their in-force cap rates have been reduced and reduced and reduced. And so they brought them over to Nationwide. It was over $100 million in cash value and ongoing premiums. These were financed policies. And I mean, while they took about a year and a half to come to fruition because the analysis was long and it was deep, as you might imagine, with that much cash. But at the end of the day, our in-force treatment of policyholders and us taking the long-term view as a mutual company really is what won the day in those cases. And I think that says it all.
Are you seeing a lot of movement from in-force policies from other carriers who've treated those policies not so well? Are you seeing that kind of migration just to get into a better design product, even if they're a few years older and maybe a little bit unhealthier?
Yeah, I would say driven by cap rates more than anything else, because the policies that I was just mentioning had up to that point really performed quite well. They were 10 or 11 years old. And so the cash value was very rich. And again, really no problems up to that point. But with cap rates continuing to go down and down and down, the future was not looking very bright. So we're seeing a little bit of that. I won't say that we're seeing it in droves, but it hasn't been that the performance isn't there. It's the cap rates on that performance, of course, that is causing people to take a second look at their in-force policies and make a determination of where they want to be for the next 20, 40 or more years.
Sure. Sure. Yeah, I mean, in the premium financing space that I'm in, obviously the cap rates have a lot to do with the overall outcome that was originally proposed to the client. Same thing with charges, same thing with loan rates, all that sort of thing. But what's your take on, I thought we were out of this free insurance crap that's been floating around and plaguing our industry for years. I thought we were done with that because there's been so many lawsuits and so many, upset clients that were sold this kind of pie in the sky dream of you don't have to pay nothing and you're going to get tens of millions of dollars of insurance. And there's ongoing lawsuits right now that are very public. But I'm still seeing, and I won't name the names of my competitors that are out there doing this, but I'm still seeing these programs. They're saying just post a bunch of collateral, don't pay anything out of pocket, and the client is not being educated by the intermediary that you might have to put up a large sum of money in the future if the little magic trick arbitrage doesn't work out so well. But I don't think they're being shown that transparently. What have you seen in that so-called free insurance market, and what's the bad and the ugly that you've seen?
Well, we have certainly lived through the worst, I would say, and hopefully that we won't revisit the Ioli and Stoli days again. That was, a representation of finance life insurance that was really unfortunate, and I think did give our industry and certainly that concept a black eye, and deservedly so. There were some not so nice things going on. Today, I think almost all carriers have a pretty good set of premium finance guidelines that we abide by. And while we can make exceptions to those guidelines, of course, for the right client and the right net worth and the right circumstance, by and large, most carriers are looking for interest to be paid out of pocket and the loan to be fully collateralized. There was a time in our industry where you could post a little bit of collateral. Loans were not having to be fully collateralized, or you could sign a personal guarantee, or there were ways that they didn't have to put up as much skin in the game. And we really do try to eliminate all of that kind of sale. And we have other requirements, showing a financed illustration next to a non-financed illustration. Are you financing because you can't afford the policy? Or you don't have the liquidity or don't have the cash flow to pay the interest out of pocket. It's really not the right prospect if they can't pay interest and they can't or won't post collateral. There's certainly a right way to do this, and ultimately, premium financing is a tool. to be used for gift tax mitigation, for example, lowering the amount of the gift to your trust outside of your estate. Maybe you have an imminent liquidity event coming in the next 1 to 3 years, and so you're financing on a short-term basis to cover that gap. Lots of reasons where you might finance, but it can never, ever be because your client cannot afford the insurance, or maybe they can afford it, but they're just unwilling to pay out of pocket for it. That would be a client that you should walk away from on a finance basis. And if they don't want to pay for it, it's not a good fit.
Yeah, it's amazing. I think both clients and advisors I've heard this from, but I think the client thinks this is possible because they've been polluted by an advisor that didn't know what they were talking about when they brought up the idea of premium financing to the client. And so I had a client recently tell me, well, I heard that if you finance the premiums, that you don't have to pay anything. I'm like, okay, did you finance the purchase of your home with a mortgage loan? Yes. Does that mean you don't have to make your mortgage payment? I mean, come on, use your brain here, guys. Come on. So
Can't end well. That scenario cannot end well.
no, and I mean, is it possible, yeah, to give my competitors that are being, in my opinion, overly aggressive out there, to give them a little bit of benefit of the doubt? Is it possible that the client is wealthy enough and liquid enough to take on that risk? Maybe. Is it possible that if borrowing rates drop substantially and policy crediting rates are greater than the borrowing rates, that they could win on that positive arbitrage over time? It's possible, but you can't, in my opinion, you can't lead with that, right? So I had a client that said, well, I think interest rates are going to fall, and I think with the current administration, I think the stock market's going to be up. And so I want to know what would this look like if I had to pay little or nothing out of pocket? Well, I'm not going to tell the client, well, I'm not going to model that for you, but in our standard proposal, we always model three different interest rate environments. We'll show a low one, and when I say low, it's the average prime rate over the last 20 years, which is just below 5%. I'll take the current rate in scenario number two, which is hovering high fives, low sixes, depending on the size of the loan. And then I'll have that reduced down 100 basis points. And then I'll have a third interest rate environment that shows interest rates ever increasing. Now, do I think interest rates are going to continue to increase? No. I think we hit a
Hopefully
peak about 6 months ago or so. We're always seeing a decline. But I want to document that we showed three different interest rate environments, an advantageous one, kind of middle of the road one, and then a really negative one, because I never want a client coming back and saying, oh, he didn't tell me that I might have to put in more interest, more pay a partial premium, or pay down the loan with some outside capital. I always want to make sure that we're transparent with that. But yeah, some of these designs that I've seen from competitors that lead the client to believe that, again, they're going to get free insurance is, to me, just a crime. I mean, how many
it is.
lawsuits have you seen in your illustrious career in premium financing where things went south and the client is suing for millions and millions of dollars? Suing the advisor, by the way, for millions of dollars, right?
And the insurance carrier. I will note that the insurance
Yeah.
carrier, often seen as the one with deep pockets, is usually also named in the suit. Not that we have necessarily, had to pay out any big claims, certainly at Nationwide, but when there is a lawsuit, everybody gets named. So what you're describing, Darren, is such a great practice, and it's a reason that Nationwide loves to partner with Lionsmark. We know that you are doing things the right way. You are being overly transparent in a really good way and showing the client what could happen. And just making sure that you're working with well qualified buyers and someone that has no liquidity. Everything is tied up in real estate, for example. They may have a very high net worth, but they may not be the best candidate for a concept like this. So net worth alone to me is not the only factor. And I know that working with you and your firm, you understand that. Likewise, because you've been through the good, the bad, and the ugly, the very ugly, you know what to do to prepare and make sure that you are fully disclosing taking care of clients, and then after the sale, which is an even bigger portion, I would argue, of the process, every single year that lender is going to be truing up collateral, even on a monthly basis, right? Truing up collateral, making sure that interest is paid out of pocket, or if it is being deferred for some period of time, that the collateral is also covering that deferred interest, and that there's a really clear exit strategy outlined so that you're not just hoping, winging a prayer that the
Yeah.
returns are going to take care of it and that you'll have enough money in the policy to repay the loan. There just needs to be a very well thought out plan. And we know that in your firm, you are doing that and more.
Yeah, no, thank you. I appreciate you saying that. It's something that a few years ago, I think I was being criticized for being too conservative. Oh, Darren, come on. The interest rates are not going to go up like that. Well, that was back when, a few years ago, I was getting money from one of our lenders at 1.35% all in. And clearly borrowing rates are not at 1.35% anymore. But I was always preaching,
Exactly.
hey, if interest rates rise, right, that changes the game, changes the out of pocket, changes the financial requirements for the client's gonna have to pony up some money. And all of those clients were not that wasn't disclosed to them. I've got a friendly acquaintance, producer has been in the space for probably 4 decades, maybe 5 decades. And he came to me with this premium financing case that he had put in. Um, at the time, it was about 8 years in, and the client was his best friend. That client is now his former best friend because things did not work out well, and the client sued him. It was a seven-figure plus lawsuit. This was his former best friend, and I felt
Devastating.
bad for the advisor because I could tell he didn't know what he sold his friend. So he
Oh,
completely relied on the premium financing intermediary to educate his friend. And of course, like many premium financing intermediaries, it was omit all the risks and only highlight the rainbows and unicorns and make it sound, like the perfect free insurance solution. And it's I felt so bad for the guy. But I think that's the thing that advisors really need to be aware of is you have when you do a big case like this, you have personal liability. You are being scrutinized in terms of ethics as well as competency. And sometimes the ethical moral compass may be okay, but the competency level is lacking, meaning the advisor doesn't really know what they're selling. If, as you've seen in the premium financing market, I don't know if you could put a percentage on it, but just kind of gut feel maybe, what percentage of advisors that do a premium financing case do you think really know what's going on?
oh, that's a really
I know
tricky
that's a
question.
sensitive subject. If you can't answer the question, I understand, but
Well, I'll give you a little bit of maybe context around it, without necessarily giving you a number. But
sure.
when interest rates were extremely low, as you were mentioning, you were getting rates down, 1.35%, which, I mean, I have a low mortgage today, which I'm so pleased with. It's not that low. That's incredibly low and amazing. But we had lots more producers getting into the premium finance business because every illustration, if you were showing those current rates and current rates only, you were able to make it look absolutely magical, right? It was a really easy sell at that point. So, compared to today, we don't see nearly as many premium finance cases. Nationwide works to keep overall finance business below 20% of the premiums coming in any given year anyway. And that's just a guideline for us, if you will. There were years where we were pushing up against that number, and more recently where interest rates have kind of more normalized, if you will, and increased. We're not seeing nearly as many of those producers that are not experienced trying to submit business.
Yeah.
I will say we have still, the folks that we prefer to work with, that I'll call you the usual suspects, that we know have been in the business a good number of years, decades, even some of you, and that have the experience. Those are the folks that are still submitting premium finance business. We really have separated out the wheat from the chaff, if you will, and we're really pleased with the cases that we're getting today. are, you're showing more conservative numbers and seeing better risks overall.
Yeah, in some ways, I think the higher interest rate environment has been a good thing for the premium financing space because it has washed out a lot of the, I liken it to like the mortgage refi boom, in like 2005, 2006, right? You had all these guys making all this money doing mortgage refis, and the crash of 2008 hit, and then right now because interest rates are up, I think there's less people refining their mortgages, and so a lot of those mortgage brokers, it's tough. It's a tough space for them to be in right now, and I
Yeah,
think
it really is.
for all parties involved, it's was why I'm so adamant about doing the right thing and being conservative and being, as you said, overly transparent. The financial devastation that can happen by doing this wrong, it's no joke. This is serious stuff. Seven, eight figures, damages. I have a good friend of mine. He does some really amazing work as I don't know what exactly you would call him. I'll just call him like it's almost like a suicide hotline counselor type of guy. And he got a call recently from a guy, and I'm sure this is happening more than more than more than anyone would hope for. Had a very successful mortgage business, big house here in Orange County. His wife's driving the luxury, SUV and the whole thing, and um, things have started to unravel. And the car got repossessed, and now the house is going to go into foreclosure, and um, it's devastating, absolutely devastating. And now this guy's in this emotional position where he's contemplating the worst horrific exit that someone could take. And I use that as an extreme example, but it's not an uncommon example of what can happen to someone when they're living the high life, and then all of a sudden things don't pan out so well, and it's just like a domino effect. And
I'm
I know
so
that
sorry
that
to
that
hear
may
that.
seem
That's
that may seem
awful.
extreme, but
Well,
people go through
you
that
bring up a
stuff.
good point, though, Darren. If I may, something else that I think maybe we don't think about too often when using an early cash value rider, as we are prone to doing in premium finance sales, just to mitigate the amount of outside collateral that the client may need to post. And maybe you use some early cash value boost, or maybe you use as much as you can use. But whenever you include those early cash value riders, the commissions are spread out over time, and so is the chargeback schedule. And we've seen too often, the chargebacks come if the policy goes sideways and is surrendered, or is taken by the bank. Whatever the reason, those chargebacks are also real. And we are as kind and benevolent as we possibly can be in working with our producers, because we know, these are large dollar amounts, but at the end of the day, they have to be repaid. And that can be a really tough situation. I like to say, I don't put my paycheck in the bank and save 100% of it for the next 5 years.
Right, right.
It's very difficult to, for anybody to do that, I would imagine, or for most folks to do that. So it's just another factor to consider. I would prefer that no early cash value riders are used unless you absolutely need to. And that way, again, you're in a normal chargeback schedule and not the prolonged chargeback schedule, because who the heck knows, the next 5 years or so, where you're going to be.
Yeah. I hate highly cash value riders. And I've said that for so long. And as you said, the reason advisors use a highly cash value rider is usually because they are either projecting their own insecurity onto the client, trying to reduce the collateral, or it's because the client doesn't have the liquid collateral, in which case maybe they shouldn't be premium financing, right?
Totally agree.
You have to have the integrity to say premium financing is not for you. And do I lose cases by being that blunt? Of course, but it's the right thing to do. And I think we're in an industry where I don't know what it is about this damn life insurance industry. Oftentimes it attracts people that want the commission more than they are doing wanting to do the right thing and then the right service for the client. I don't know why that is so prevalent in this industry. I guess you could say that's other industries are plagued by that greed as well, but it seems like this industry has been plagued by that mindset for a long time, and I'm hoping to change that one little brick at a time, you know?
One YouTube video at a time. I love
Yeah,
it.
there you go. Yeah, that's it. That's it. Awesome, awesome. Yeah, I've really enjoyed working with you over the years. I will say this, and this is one of the highest compliments I think I could give somebody. Every time I see you at a conference, on a Zoom call, whatever it is, every interaction I have with you, you make me feel special. And I think you
Aw,
have that gift to make other people feel special and I think I remember hearing someone they say this a long time ago. They said everyone's walking around with an invisible sign on their forehead that says, "Make me feel special. Please make me feel important." And you must have that X-ray vision because I think you see that sign in everyone's head. You make people feel special, not just me, but I think everyone you come in contact with.
oh my gosh. Thank you. That is an extreme compliment. I really do appreciate it. We do get to work with some good people in our industry, and I do count you among them. So
Yep.
it's always been a pleasure to partner with you, Darren, whichever company I've been with, just two, at least in the last 25 years.
Yep.
But
Yep.
I really appreciate that. Thank you.
Absolutely. Anything as we wrap up here, anything else we haven't talked about regarding Nationwide that you think the producer audience needs to know?
The only thing I would mention is around, needs-based placement of life insurance. We talked a little bit in the beginning about, running illustrations, and the illustrations are, although well-intended, don't always tell the whole story. I would argue that a needs-based approach to placing the life insurance and making it part of the client solution is just as important, if not more important. I work with a business coach named Chuck Hollander, and Chuck has done a really great job with our team reminding us that you have to start with the client's goals. And if you believe your client's goals is just to avoid taxes, mitigate taxes, you really don't know the client's goals. You need to get in there and understand the why behind it. Who is benefiting? Why is it important to them? And getting to the heart of that matter. And then the insurance does not become a commodity. The insurance becomes part of the solution. Financing, if you're financing, just becomes a tool and a means of accomplishing that solution. But that's would be my final reminder, is just to make sure that you're really approaching the insurance sale with a needs-based mindset and a true understanding of what that client is trying to accomplish and why.
Great advice. Great advice. Well, thank you so much for joining us today. Again, love working with you and your whole team, and looking forward to the second half of this year really turning up.
Awesome. Thank you
All
so
right.
much. I appreciate the opportunity.